Welcome back, traders and creators. In today's video, we're going to go over a in-depth overview of USD Swiss franc on the hourly time frame, and we're going to cover how exactly you could have caught over 70 or even 80 pips on this pair or this move, and then I'm going to show you in depth how you could have quadrupled those profits just by going on smaller time frames. So the first thing that we want to do is understand why we would have taken that buy in this area, and I'm going to take this purple box away and break it down. So basically what we have is we understand that we are in a downtrend, but in the overall broad view, when we look on higher time frames, I'm just going to mark this out so we don't lose it, but if we look on higher time frames, we understand that we are in a long trend, a long uptrend, right? We have that higher high, higher low, and now we're starting to come back up. But for a lot of people who don't look at the bigger picture, this definitely looks like a downtrend. But when you open up your eyes and look at the bigger picture, you understand that really we are in an uptrend, and this is just a retracement. So now knowing that we are in an uptrend and we're looking for areas in order to buy, we need to start looking for areas in which we can buy. So if you haven't seen previous videos on the FU method, I highly recommend you go check those out, because that is going to help you understand why this area was such a good buying opportunity. Now, when you look at it just from this close, and you don't look at any previous data, it's really hard to understand why you would have bought this consolidation and then out of nowhere the market spikes up. But to make this quick, basically, the reason that we would have bought in this area is because of a method called the FU candle method. That method is basically stating that big banks or big players are going against retail stop losses, taking them out of certain trades, and then reversing the market. Because once you can take out the majority of traders, then all the profit goes to a certain few. And the reason, if you look all the way left, you'll understand that we have lows right here and lows right here. And typically stop losses are always below the lows or above the highs. And if you extend this out, you can then see that right here we have stop losses, right here we have stop losses, and right here we have our wick, a wick that took out all of those traders. Now, right here is where the FU candle was, and we know that because this is the wick that takes out all those stop losses and then reverses the markets. And now you're probably asking, like, dang, how could we have gotten into this? You know, if you're just looking at this consolidation, well, maybe you could have waited for it to break out of this consolidation zone, maybe above these highs, and then you could have entered the market maybe around here and then brought it up for about 80 pips. Right? So we're going to use the long position to see exactly how much we could have made on this trade. So let's say we wait for it to break out and we go over here. Our stop loss can be about 20 pips right below that low, because we know that no more retail stop losses are below this because they were already taken out by that FU candle. And then we bring our take profit above the highs where other sellers would be, and we can see that our risk to reward would be 3.82 to 1. 80 pips, and we're risking 20. Now we're going to go on smaller time frames. I'm going to show you exactly how we could have capitalized on this trade and almost doubled or even quadrupled your profits. So what we want to do is, you can always go down just to the next smallest, but just for time's sake, we're going to jump down all the way to the 5-minute, because we know that this is an area that we're interested in, and we know that retail stop losses were taken out. And so you want to look at the bigger picture when you're trading, more for the direction, and then you want to look at those lower time frames more for precision. So let's break this down again. We know that stop losses were taken out right here. So to zoom in, we can see that the market comes down, takes out this area on the 5-minute time frame. This is where all of those retail stop losses were taken, and then you can see the market shift, push out of that zone because there's no more retail buyers, and now you only have the big buyers. So that price shifts out of that zone, and this is where the market starts to switch its trend. But how could you have gotten into this? Well, you have to ask yourself, where did big money start selling? Well, big money starts selling where you start to see the market drop. and that is right here in this wick. You see this massive drop, and then from this point down, you can see that this would be your entry area. Reason being is because this is where all those big money stop losses, where all the big banks and the hedge funds are selling, and in order for them to buy up, they have to sell to buy. And before the market can continue to trend up, they need to mitigate out of their buys so they can only have buy positions open. I'm hoping this is making sense to you guys. If it's not, definitely watch the other videos. But basically, this is going to be your entry zone. And as you can see, the market comes out of this zone and then dips back into it. Them, therefore, closing out their sells at break even, but keeping open their buy positions. So what you would do is you would capitalize on them, taking out all the retail stop losses, reversing the market, and then coming back to mitigate out of those trades. Now let's say you did understand this and you took your trade right at that area. You can now see that your stop loss, instead of 20 pips, is only 7. And now you can continue to take your take profit to the same area because you understand that all those stop losses are still above these highs. And now you can see that your risk to reward is no longer 3 to 1, but it's almost 8 to 1. And so now you can almost double or even triple your profits. And even if you take them up to these highs, you can see we're still shooting for 80 pips, but yet our stop loss is a lot smaller and we have over 10 to 1 risk to reward ratio. So I hope this video helped you guys understand why it's so important to look at the bigger time frames for direction and then small time frames for precision. I'll see you guys on the next video.